Good morning, and welcome to this morning's Business for Breakfast presentation. While we certainly missed the opportunity to see you all in person today, we welcome you to our virtual presentation this morning. My name is Kirk Monroe, and I'm the Executive Director of Banking Services at Vectra Bank, Colorado. On behalf of our event sponsors, RubinBrown and Sherman and Howard, I'd like to welcome you to this morning's webinar. Our organizations partner to offer you valuable information to help your company thrive. With that said, if you have questions during the course of the presentation, we welcome you to use the chat feature and we will address your comments accordingly. I doubt many would dispute how unusual 2020 was in American politics. Therefore, I'm confident today's event, the political environment's impact on tax policies and your business, will be of particular relevance. In fact, earlier this year, a Gallup survey determined that business owners say taxes are the greatest impediments to their business operations. Today, you will learn what a change in administration can mean for your company's tax bill, how the House and Senate will play a role, and the potential impacts to Colorado's businesses based on the national political environment. I am pleased to introduce Tony Nitti, partner in charge of national tax at RubinBrown, and a well-known contributor to tax content to Forbes, NBC Nightly News, and the Wall Street Journal. Welcome, Tony. The floor is yours.
Thank you so much. Good morning to everybody. Yeah, well, this is good timing for this discussion, let me tell you. So Tuesday night, I think like a lot of the country, I was certainly keeping an eye on the elections in Georgia, but, got late. I went to bed before anything was really called. And when I woke up in the morning, before I even had a chance to really, take in the news and see what had unfolded, I had a pretty good idea of what the results were, because I had a text message on my phone from a reporter that I work with from time to time at CNBC saying, hey, can you jump on a call this morning to talk about Joe Biden's tax plan? Okay, and so what that told me, as we're going to kind of discuss here today, is I had a pretty strong indication that both of those Senate runoff elections in Georgia had gone the way of the Democrats. And so when the country, like I said, kind of arose on Wednesday morning, there was certainly a renewed interest in the future of tax policy, okay? Now, I am not gonna sit here and assume that everybody follows the intricacies of the legislative process or tax policy or the history of tax policy. Rather, I'm gonna spend our time together, making sure we understand why those Georgia elections were so important and where we go from here from a tax perspective. Okay, so it should be a fun little morning. Personally, I love talking about, peeling back the curtain a little bit, seeing how the sausage gets made, understanding the history of tax policy and how it shapes our tax policy for the future. And what we're going to see here, okay, the big takeaway, the reason there was this renewed interest, obviously, on Wednesday, is that Joe Biden has not been talking about making subtle tweaks to the tax law. What we're talking about are historically significant tax increases, okay? I mean, they're not the largest that have ever, been proposed, but they are historically significant. Now, when Joe Biden on November 7th was, kind of declared, so to speak, from a media perspective as being the 46th president of the United States, you can imagine that my phone started to ring off the hook from clients and contacts saying, well, what does this mean? What does this mean? What's going to happen to my tax bill? What are going to happen to tax rates? What's going to happen to the estate plan? And like any good tax accountant, I would give them the only answer you can give to most thoughtful tax questions, which is what? It depends. Okay, it depends. We know what Biden has proposed, and we're going to talk about it. But what I would explain to people is for that proposal to ever see the light of day, it depends on 4 things happening. Okay, now here we stand on January 8th, and only 2 of those it depends have been resolved, right? So you're going to see that we're still in a state of uncertainty. How uncertain, is really still to be determined. So before we jump into kind of the political landscape, I just want to do the all-important caveat that you have to do in this day and age. We are going to be talking about policy. It is impossible to talk about policy without sounding at least like you're talking about politics. okay? But I assure you, my allegiance up here is not to the right or to the left, to the red, to the blue. It's just to the tax policy and the math and who gets cuts and who gets increases and what the numbers say, okay? So any political leanings you extract from my presentation, I promise you, they are of your own imagination, because I know no one cares about my thoughts other than on tax policy, and that is perfectly fine by me. So there were 4 it depends that had to kind of be resolved before, Joe Biden's tax proposals could ever see the light of day. And the first, right, created no shortage of controversy. And technically this wasn't resolved until after the Georgia runoffs, but we had to ensure that Joe Biden was going to be the 46th president of the United States. And we all know how that went. We don't need to rehash it. It wasn't kind of the typical transition that we're used to seeing, but yesterday, or not yesterday now, well, yeah, technically yesterday morning around 3 a.m., the Electoral College votes were certified, and now it's just 13 days and Joe Biden will take office. So we know that Biden will be the 46th president. Again, that was the first it depends that had to happen. The second it depends, though, speaks to the fact that, look, when you talk about tax policy, who the president is, kind of a symbolic gesture, right? What's really important, obviously, because of our legislative process, is the makeup of the House of Representatives and the Senate. Now, the House, right? The House is controlled by Democrats, as it has been since 2018. Now, interestingly, and this will become important in our conversations, the House was expected to widen its majority. I'm sorry, the Democrats were expected to widen their majority in the House in the 2020 elections. That's not what happened, right? The majority actually got slimmer. And as I said, plant that seed in your brain. We're going to come back to it a little bit later. But Democrats continue to control the House, right? Where a majority rules, generally speaking, for passing a bill. The real drama was in what? Was in the Senate. There are 100 seats in the Senate. And going into this week, the score, if you will, was Republicans 50, Democrats 48. Where were the other 2? We all know this by now. The other 2 came down to not 1, but 2 runoffs in Georgia on January 5th for the 2 Georgia Senate seats, right? Why? Because back on November 3rd, none of the 4 candidates got the requisite 50% of the total vote plus 1 vote. And under Georgia law, when that happens, you go to a runoff. So talk about just a unique, string of events. I mean, number one, we had the controversy about the presidential election in Georgia, and then all eyes remain on the state because you got not 1, but both of their Senate seats at stake. And if you heard people talking about those 2 seats as if the entire future of not just tax policy, but Joe Biden's legislative plan rested on the outcome of those 2 races, to a degree, those claims are correct. Why? Well, let's say that Republicans won even a single seat in that race. That would have made the score 51 to 49. If you hearken back, right, to your childhood days, lazy Saturday mornings watching episodes of Schoolhouse Rock, you may recall that when a bill gets to the Senate, right, it needs 60 votes for passage. So if you're Joe Biden and you have 49 seats in the Senate and you want to pass your tax bill, what are you going to need? Well, you're going to need 11 of these Republicans to jump over, cross the aisle, and agree to your bill. And trust me, when we get into the details of Joe Biden's tax proposals, right, a $3.5 trillion tax cut over a 10-year window, no Republicans are going to be crossing the aisle to vote for that bill. So if even one of those 2 Republican senators had won a seat on Tuesday night, you can forget it. We wouldn't be having this conversation right now about Joe Biden's tax plan. It would never, ever come to fruition. But if Democrats won both seats, which again is certainly what appears to have happened, all of the game changes. But why? Why does the game change? If it's 50-50 and you need 60 votes for passage, then I don't understand how you're in a significantly better situation, right? Instead of needing 11 Republican senators to cross the aisle, you would need 10. Is that really any more likely? Well, the thing we all have to understand is the reason all eyes are on Georgia, the reason they were saying it was so important to get to 50 in the Senate is because if the Democrats could get to 50 seats in the Senate, suddenly the stars would be aligned, right? And the stars would be aligned because Democrats would control the White House, as we already saw, they would control the House, and they would then control the Senate. Now you might say, well, how do you control the Senate if you only have 50 and the other side has 50? Well, in the event of a 50-50 tie, what happens in the Senate? Vice President Kamala Harris would cast a tie-breaking vote as a Democrat. You know which direction that's going to go. So this is where you pause and say, but I still don't get it. What good is a 50-50 tie when you say you need 60 votes for passage in the Senate? Well, when you control the White House, the House, and the Senate, you can employ, subject to budgetary and procedural limitations, a streamlined process called budget reconciliation. And when you use budget reconciliation, what's so significant about it is when the bill gets to the Senate, it no longer needs 60 votes for passage. Instead, it needs what? A simple majority, 51 votes. Well, Democrats got 50. If everyone votes for it, what happens? The worst they can do is a 50-50 tie. Kamala Harris casts the tie-breaking vote, bill passes. And so, right, the rhetoric you'll hear around the country right now is that the Democrats, right, are in a position of tremendous strength. They can pass certain bills that impact revenue or spending, something like a tax bill, without a single vote from a Republican in the House or the Senate, which means they don't need to invite, right, the Republicans to even, help craft those bills. Now, do we typically see this used for tax policy? Well, we don't have to look too far back in history to see that, yes, we do. This is how President Trump passed the Tax Cuts and Jobs Act back in 2017, right? As you'll recall, the shoe was on the other foot back then. The Republicans controlled the White House, the House, and the Senate. And this is important. They had a healthier majority in both the House and the Senate than Democrats do today. They had 53 seats in the Senate, okay? And so, yes, they were able to push through the Tax Cuts and Jobs Act without a single vote from a Democrat and without inviting Democrats to the table. Why is that so significant? Well, because it certainly increases the likelihood of significant tax changes under a Biden presidency, because the most recent round of tax reform in 2017, the Democrats were not invited to the table. So now that the shoe is on the other foot, right, do we expect the Democrats to say, we're content letting the Tax Cuts and Jobs Act be the law of the land? Of course not. Okay, of course not. So when I was teaching the Tax Cuts and Jobs Act a couple of years ago to people, I would remind them that when you pass a bill using budget reconciliation, which you're certainly entitled to, that bill is only as permanent as what? Control of that party, right? Once control swings, then you're at the mercy of the other side taking their bite of the apple. So this was the second big it depends before we could have tax reform. Democrats had to win both Senate seats. And to the surprise of many, that's come to fruition, right? So the stars are aligned now for the Democrats. They could use budget reconciliation to push through their vision for tax reform without a single vote from a Republican. But I said there were 4 it depends scenarios that had to be addressed, not just 2. So what are the remaining 2? Well, as we just said, right, Democrats can do whatever they want. But the third it depends is, will they, right? Will there be an appetite for it right now? Because, right, this isn't 2017 in the sense that we are now in the midst of a global pandemic. And as we're going to see, the Biden proposal is, as I mentioned, a significant tax increase. It is a targeted tax increase on the highest earning 5% in corporations, but a tax increase nonetheless. And will it be politically palatable for an administration's first real act to raise taxes on a number of Americans during a pandemic and, an economic downturn? And so listen, that's something we're going to have to wait and see. Will there be other priorities? My guess is there will be. My guess is the priorities would be, more of a stimulus and infrastructure package, and think more about tax increases at a later time. Of course, right? Those two sometimes go hand in hand, right? Can you do stimulus? Can you do infrastructure if you're not paying for it? Can we just continue to add to the old company credit card here and put money on, add money to the deficit? So at some point, right, tax revenue might need to be raised to try to pay for these programs. But it's just hard to imagine that, again, given the climate we're in, the first order of business would be to raise taxes. But let's say, right, that's not the case. And let's say that third, it depends, moves forward full steam ahead. We want to increase taxes, right? That leads to the fourth, it depends. And to me, this is the more meaningful one that maybe we're not talking enough about. Yes, Democrats can pass tax reform without any Republicans, but it ain't going to be easy. This is not 2017 again, right? 2017, Republicans had a healthy majority in the House, 53 seats in the Senate, and were unified behind the idea of giving President Trump some form of legislative victory in his first year in office, right? And we'll talk about why it was so important here in a couple of minutes. But there was, right, they were unified as a party. But think about what I'm telling you now, right? What I'm telling you is we're looking to raise $3.5 trillion in taxes under this Biden proposal in a landscape where Democrats have a very slim majority in the House and no majority in the Senate, a 50-50 tie. And so what that does is, in the Senate in particular, is effectively gives every single senator, right, veto power over a tax bill. Because if they don't like one sentence, or if there's something in there, not in there that they want in there, if one Democratic senator says, I'm out, the whole thing falls apart because no Republicans are going to vote for it. And that is very tricky. I mean, even in 2017, right, when they passed the Tax Cuts and Jobs Act, there were some iffy moments there, right? I mean, because they had 53 Republicans, but you have Rubio and Lee banding together and saying, well, we're not going to vote for the bill unless we get this. And then you have Ron Johnson saying, well, I'm not going to vote for the bill unless I get that. And it gets difficult. Imagine how difficult that gets when you can't lose a single vote. And all it's going to take is one moderate in the Senate, right, to say, I'm not on board with raising taxes this significantly, and no tax reform happens. And so I'm not here to give opinions or predictions, but I just want to caution everybody that it's a tough time to imagine a completely unified party among the Democrats for the types of tax increases we're going to be talking about here in a moment. And so this may not be possible until 2022 midterms to see what could happen in the Senate, what could happen in the House. And if Democrats end up with a larger majority, right, then it becomes much, much easier to do. Now, this is where you might say, Tony, come on. In today's hyper-partisan environment, everybody votes on party lines. It's really not true, right? How do I know this? Go back to 2017. When President Trump took office and they could use budget reconciliation, did they, take the first bite of that apple by going after tax cuts? They did not. They tried budget reconciliation first, right, for something else. What? To repeal Obamacare. And how did that work out? It didn't, right? Because 4 Republican senators walked away from the table and said, no, we don't have anything to replace it with, right? We're not going to vote for this bill. So, we're not in such an environment where it's a slam dunk that every Democrat is going to vote for this bill, okay? And so it's a tricky landscape, right? Wall Street Journal, Richard Rubin had an article yesterday talking about where we go from here. Obviously, right, if we were keeping a percentage likelihood, like they do in the NFL games, the likelihood a team's going to win given the current circumstances. When Tuesday morning had arrived, the likelihood of tax reform was maybe 1 or 2%. After 2 victories in the Senate race, clearly that jumps up significantly, but there's still a big gap before it's any type of slam dunk. All right. So I just want to make sure all of that is clear. So with all that understood about the landscape, right, and what it's going to take to get it done, why don't we spend some time talking about what it would look like, what is being proposed, okay? Now, the first thing we have to accept is that, we are working in a tax law that, regardless of what the Democrats may do, is temporary by design. Why? Well, this all ties together, right? When we talk about the legislative process. How was the Tax Cuts and Jobs Act passed? I said using budget reconciliation. You can't use budget reconciliation with impunity, okay? You have to kind of set limits. And so when they said we're going to use budget reconciliation to cut taxes, they could do that, but they had to say we're not going to cut taxes by more than X amount. And that X amount was $1.5 trillion, okay? And then there's this over 10 years. Then there's a second piece to that budgetary process where you can add 1.5 trillion to the deficit over 10 years, but you can't add anything to the deficit beyond the 10-year window. Well, the Tax Cuts and Jobs Act was actually running into that second problem, what we call the Bird Rule. It was adding to the deficit beyond 10 years. So how did they fix that problem? Well, they took every individual change in the law, from the lower ordinary rates to the double estate tax exemption to the double standard deduction to 199 cap A, and they made them all temporary, right? When the clock strikes midnight, December 31st, 2025, like Cinderella's carriage reverting back into a pumpkin, poof, they're all going to disappear, all of it. And all the law goes back to where it was in 2017. Now, this is the reason I gave you this history. This bill was passed only by Republicans. So clearly the new Democratic administration will have zero interest in making any of these TCJA provisions permanent. So at a very minimum, even if nothing happens in the Biden administration, we are going to be dealing with a tax law that is forever inching closer to this big, Cinderella moment where everything disappears and sunsets. Now, it's not till the end of 2025, we'll have another presidential election by then, but still, right? It's just something where it makes long-term planning difficult when we don't know what the rates are going to be. Now, the business rates, the corporate rates, the 21%, that stuff's all set in stone. Those are permanent changes. It's these individual rates here that, are going to expire at the end of 2025. So, what is Joe Biden proposing, and how on earth did we get here, right? Biden ran on a policy that openly said, we're going to raise taxes, right? Anywhere from $3.5 to $4 trillion in tax revenue over the next 10 years, and won the election, right? How does that happen, right? How do we get an appetite where voters say, hey, I know you're saying we're going to raise taxes, right? We're fine with it. Well, here's where the history gets a little bit interesting. And I do think it's fascinating, and I do think it's worth discussing, right? Because it's something that we saw the writing on the wall several years ago. So the Tax Cuts and Jobs Act passed at the end of 2017, effective beginning of 2018, right? I'm going to give you two facts about that Tax Cuts and Jobs Act that when you hear them back to back, it doesn't line up, right? Like there's got to be some disconnect. How can those two things coexist? They should be mutually exclusive. Fact number one, regardless of how, specific individuals might have been impacted by the changes, the math doesn't lie. 9 out of 10 people making more than $40,000 a year got a tax cut in 2018 from the Tax Cuts and Jobs Act relative to what they paid in 2017. 9 out of 10 people paid less in the way of federal income tax in 2018 than they did 2017 if they made more than 40 grand. That's fact number one. Fact number two, the highest the Tax Cuts and Jobs Act has ever polled in terms of whatever you want to call it, right? Popularity, approval among voters, the highest, 38%. Now, how can those two things coexist? How can a bill give tax cuts to 9 out of 10 people making more than 40 grand a year and only 4 out of 10 be happy about it? And the answer speaks to human nature, okay? It's the most true thing you'll ever hear me say. The only thing people hate more than not getting a tax cut is getting a tax cut, but to believe in their heart of hearts that their richer neighbor got a bigger tax cut. And that is something that has plagued the Tax Cuts and Jobs Act since before it was passed, okay? On November 2nd, 2017, a month and a half before the bill was finalized, the House kind of launched its opening salvo in the tax reform process by releasing its bill. And the Tax Cuts and Jobs Act had been promised to the public as a middle-class cut, right? And matter of fact, President Trump, Steve Mnuchin had come out and said the richest 1% will have no net benefit under this plan. The problem is that initial House bill was a disaster. The overwhelming majority of the cuts went to the richest 1% and corporations. The math does not lie, okay? Now, the fascinating thing about this is it's the first time in this country's history that we had tax reform unfold in the era of social media. And we know in the era of social media that once a narrative is built, it is extremely hard to change it. Only we don't have narratives in the conventional sense anymore. What do we have? We got hashtags. And right away in November, a hashtag started to trend, and it was not a good one, right? It was called GOP tax scam. And you'll still see it arise on Twitter every now and then. But people were saying, hey, this is a scam. You're getting a little bit, but the richest 1% in corporations are getting a whole lot more. Now, the thing is, the Tax Cuts and Jobs Act improved significantly before it was passed on December 22nd. Gave much more of the cuts to the middle class. But again, the numbers do not lie. About 52% of the tax cuts went to the richest 1% in corporations, okay? And so the narrative persists and has persisted that while the middle class did okay, the richest 1% in corporations did a whole lot better. Why is that important? Because think about it. If you're Joe Biden, you're Elizabeth Warren, right? You're Cory Booker, you're Bernie Sanders. If you have data that shows that 6 out of 10 people are angry at the Tax Cuts and Jobs Act because they think it was a giveaway to the richest 1% in corporations, it doesn't require the master touch of a brilliant strategist to come up with what your tax plan should look like in order to be politically palatable if you're a Democrat, right? If people hate the Tax Cuts and Jobs Act for giving cuts to the richest 1% in corps, what should your tax plan do to be politically popular? Tax the heck out of the richest 1% in corporations. And that's what we saw in the Democratic primaries. We saw things we've never seen in this country's history being proposed, right? Now, Bernie Sanders was talking about a top rate over 70%. We've had that before. That's not historically new, but 70% on income over 10 million. An estate tax rate of 77%. Elizabeth Warren, here's what we hadn't seen before, was proposing not an income tax on the wealthy. She was doing that too, but what? An annual wealth tax, right? An annual wealth tax on just somebody's, right, value of their assets at the end of every year. We don't even know if that's constitutional as a direct tax. So we saw, right, this unified approach from the Democrats that said, here's what we're going to do. We're going to pay for social programs by increasing taxes, but targeted tax increases only at the richest, 1 to 5% plus corporations. And Joe Biden took a page from that. Now, a much, much more moderate plan, right? The plan we're looking at today, according to the Tax Foundation, would raise revenue by about $3.3 trillion over 10 years on a static basis. Bernie Sanders' plan was 4 times that big, right? So $16 trillion. But Biden, nonetheless, right, has taken that same approach. I'm going to raise your taxes, but only on the richest, and I say richest, I mean the highest earning annually, 5% in corporations. Matter of fact, Biden took the extra step, which is not going to be an easy thing to deal with, of saying, if you earn less than $400,000 a year, under my plan, you will not experience an increase. As a tax person, that makes me nervous. Why? Because I got 9 volumes of code and regs over here on my desk, and those provisions all interact in weird ways. So when you try to draw a line in the sand and say nobody under 400 grand is going to have an increase, it's possible, but it ain't easy. And what you have to do to make it happen is layer on top a lot of additional complexity, which I don't really need in my life. But let's see how this would work, okay? So at long last, what is in the Biden plan? And you're going to see some really interesting stuff here. Now, first things first, the headliner of any tax plan is just what's the top ordinary rate, right? Bernie Sanders was looking at 70, Elizabeth Warren was looking at 56. Under current law, it's 37%. You make more than $520 if you're single, $620 if you're married, you're paying 37% on those last dollars of income. Well, where did Biden land? Was it close to Bernie's 70 or Warren's 56? No. He said, what I'm going to do is go back to what it was before the Tax Cuts and Jobs Act. Flip that number back to 39.6%. Why? Why would that be all he did, right? Like if you're intent on taxing the richest 1 to 5% corporations, why stop at 39.6%? When AOC floated a 70% rate on income over $10 million, it was met with 67% approval from voters. You know why? Because most voters are never going to sniff $10 million in a year, right? I mean, that's a different stratosphere. So why did Biden stop here? He stopped here probably because he's got savvy advisors. And those advisors said, look, raising the ordinary rate to something like 70% on income over 10 million, it's a symbolic gesture. It doesn't actually raise any significant revenue to employ your social programs, because there's two things, right, about trying to raise ordinary rates above 10 million bucks. Number one, most people making more than $10 million in a year, they're not doing it on a W-2, right? They're not somebody's employee, right? They're doing it in one-off capital events, sale of a business, sale of stock, sale of a building, right? And those items are what? Not subject to ordinary rates. They're subject to the preferential rates for capital gains. And the second thing is, even if you do have someone earning more than $10 million in a year in ordinary income, you know what they have? The wherewithal to hire savvy tax advisors to make sure their income never sees a 70% top rate. And so you raise that rate high, it just gets people angry. It doesn't actually accomplish a whole lot from a revenue raising perspective. There are better ways to raise revenue. Now, one of the things he'll do that probably hasn't gotten enough attention as far as an increase is change the payroll tax structure. Right, under current law, up to 137,700 of wages or self-employment income in 2020, you pay payroll tax, right? But it's split. An employer and an employee split a 12.4% Social Security tax, and they also split a 2.9% Medicare tax. Now, above 137.7, the Social Security tax disappears. All that's left is Medicare. That's how it works under current law. What Biden would do is say, hey, when we get above $400,000 in wages or self-employment income, we're bringing back that Social Security tax, right? So that's significant. If somebody were to get a W-2 of, say, $600,000 as a single person, that last $100,000 is not just going to be taxed at 2.6% more of individual rate, ordinary rate. It's going to be taxed at another, right? The last $200,000 is going to be taxed at another 6.2% of payroll tax. So you start getting up into that neighborhood of, 9% rate increase on your last dollars of income here when you couple the income tax with the payroll tax. Now, there would be a donut hole. Between 137.7 and 400, there would be no Social Security tax. It would just kick back in at 400. But if you really want to raise taxes, as we said, on the highest earning 5% in corporations, how do you do it? Economists, tax policy experts have kind of long agreed. You do it by eliminating the preferential rate on capital gains and dividends. Under current law, you sell stock, right? You sell certain assets, like buildings other than depreciation. Well, there is no depreciation capture anymore, but you get the idea. You sell certain assets you've held longer than 1 year, you pay tax at a top rate of 20%, 23.8% if you factor in the net investment income tax enacted as part of Obamacare. Well, Biden would say, hey, no more. If your taxable income for the year is over $1 million, then on your capital gains in excess of that amount, you're not going to pay preferential rates anymore. You'll pay what? Ordinary rates. What did we say that ordinary rate was? 39.6%. So yes, what I'm telling you here today is there is a possibility. How real is that possibility? We don't know yet. There is a distinct possibility that capital gains rates could be doubling for some taxpayers in the coming years. Now, again, only with income over $1 million, but that's what's being proposed. Okay, and it's a huge part of his plan. So I don't see him going forward with his plan without this. The question is just, would a Joe Manchin in West Virginia support this, right? We'll have to see. Now, the 199 Cap A deduction we've gotten used to over the last few years, that 20% deduction owners of S-Corps and partnerships get against their business income. We know it gets very complicated when the owner's income gets above a certain threshold. You lose the deduction if you're in a bad business, doctor, lawyer, accountant, actor, athlete. And also the deduction might be limited, right? If you don't have enough W-2 wages or property basis inside the business. But as of today, there's nothing that says, hey, you're in a good business with plenty of wages, but you lose the deduction simply because you make too much money. Well, Biden would change that. Once your income as the business owner gets above $400,000, you would start to lose the 20% 199A deduction, which means your top rate on business income would shoot back up potentially from 29.6 under current law back up to 37. Well, the math would actually change because you'd be offsetting against a 39.6 rate. So you'd end up back at 39.6. So someone just asked a good question that at one point I actually had an example of that saw how it worked. But does the $1 million income requirement for proposed capital gains rate increases mean 1 million before capital gains or after? It means you take your total taxable income for the year. And the first thing you do is, again, if it's over $1 million, you're going to have a problem. You carve out kind of your income tax at ordinary rates and apply those principles. And then you would go to your capital gains rates. And you'll see that under current law, the top rate on capital gains, 20% kicks in somewhere around $400,000. If you end up with capital gains in excess of $1 million, there's going to be a later threshold that takes that excess gain and taxes it at that ordinary rate of 39.6%. I'll see if I can piece together an example when we're done the day. But yeah, you'll have to have, if you have taxable income before, including capital gains of over $1 million, that's what's going to potentially subject to a higher rate, but it's really going to depend on, you'll still get the benefit of lower capital gains rates on your first dollars of gain, right? 15 and 20. It's just going to be the incremental above $1 million that would be taxed at the 39.6% rate. So then Biden would take aim at itemized deductions. He would start to eliminate itemized deductions once income exceeds $400,000 by bringing back what we call the P's limitation. And then he would cap the benefit of itemized deductions at a 28% rate. This is something the Obama administration had proposed for a long time, right? Because that's a hidden surtax. If you're paying a top rate of 39.6 on your last dollars of income, but only getting a deduction of 28% on your last dollars of deduction, I'm no genius, but that's an 11.6% surtax buried in there, okay? Now, he would have to make some accommodations here because this 28% rate, if you really applied that just by saying, hey, as your brackets move up past 28, you only get the benefit of 28% deduction, you would raise taxes on people well under $400,000 because the 33% income bracket starts around 250K. So unless he puts in a safeguard, someone making say 270 would pay 33% on the last dollar of income and only get a 28% deduction. That can't happen, obviously, based on his promises. A more interesting thing I don't think has gotten enough attention is the change he is proposing to retirement contributions. Under current law, right, you put away some money into a 401k, you don't pay tax on it, right? You put money into a deductible IRA, you take a deduction for it. The benefit you reap is dependent on your tax bracket. If you're in the 25% bracket, then you'll get a 25% benefit. You're in the 37% bracket, you'll get a 37% benefit. Well, Biden doesn't want retirement planning to be skewed by your amount of money you make. So he would replace the deduction and exclusion system with a credit system that just says, look, I don't care if you make 300 grand or 30 grand. If you put away $1,000 into a 401k, we're going to take that $1,000, multiply it by a credit rate, say 26%, and everybody will get the same exact $260 credit for that amount, whether you make the 30 or you make the 300. Okay? Now, Biden's plan is not just increases on the richest 1% in corporations. There's also a menu of refundable credits for lower income taxpayers. Remember when I said that the Tax Cuts and Jobs Act cut taxes for 9 out of 10 people making over 40 grand. I didn't say anything about under 40 grand. Why? Because by and large, you make less than 40 grand in a year, you don't end up owing a tax liability. Okay. It's not always true, but by and large. So the only way you can give a benefit to people who don't owe taxes in the first place is what? To give them more refundable, right, credits. So that actually puts money in their pocket. The Tax Cuts and Jobs Act, other than a small tweak to the child tax credit, did not endeavor to do that for low-income taxpayers. It was just not part of that plan. Well, Biden would do that many times over, right? He would expand the earned income tax credit for childless workers over age 65. The child tax credit would change significantly, right? I had a friend call me a couple months ago, said, hey, I'm having twins next year. What happens to my tax law? What did I say? Or tax bill. What did I say? It depends. Under current law, right, you would get a maximum credit of $4,000, but only $1,400 each would be refundable. Under proposal by Joe Biden, kids under the age of 6 would be eligible for a $7,200 credit total, $3,600 a piece. But more importantly, right, it would be fully refundable. That's a big difference. $7,200 refundable credit versus $2,800. He would then do the same kind of thing to child independent care credit, increase the credit from $3 grand for a family up to $8, make it 50% refundable, give you a $15,000 credit for buying a home for the first time. There's a renter's credit mixed in there. There's a whole lot. Now I see a question come in, which is a perfect segue into my next slide. The thing that's got people up in arms and concerned and is going to keep my industry very busy if it comes to fruition is the changes to the estate tax provision. Under current law, if you die and the value of your assets are worth more than $11.5 million as a single person, you'll pay tax on the excess value at a rate of 40%. But you're never going to pay tax on the appreciation in your assets because your heirs take those assets with what we call a stepped up fair market value basis under Section 1014, so that if they turn around and sell the assets, no gain results. Well, Biden would take aim at all three of those aspects of the estate tax regime, right? He would drop the exemption from 11.5 million down to 3.5. He would raise the rate from 40% to 45%. But most importantly, he says he would do away with tax-free step up in basis upon death. We don't know exactly what that looks like. Would death itself become a realization event where, you know, the estate would pay tax on the appreciation, or would the heirs eventually pay tax on the appreciation by taking a carryover basis in those assets? Okay, so this will have some people, right, worried. Then from a business perspective, right, the corporate tax rate was 35%. It went down to 21, got a lot of people excited. You couple 21% rate with Section 1202 benefits, and suddenly C Corps are not the entity choice of last resort. Well, you know, Biden would leverage off an Obama era plan and raise that corporate rate to 28%. And we're going to have to see, right? I think this is something that could be done not as part of, you know, if a whole package falls apart, I could still see there being some play in the corporate rate with bipartisan support. People forget, but 8 years ago, 5 years ago, Republicans would have been ecstatic with a 25% rate. They would have accepted a 28% rate. The only reason we landed at 21 is because President Trump had campaigned on a 15% rate until we found out that would add $12 trillion to the deficit over 10 years. So we landed at 20, and then in the conference committee to the Tax Cuts and Jobs Act, moved it up to 21%. So could there be some wiggle room where Republicans would be willing to go to 25 if they got something they needed? It is definitely possible, okay? Last thing, I don't like to talk about it much because I just don't see it ever happening. It's been universally panned by economists and you know, tax policy experts. But Biden realizes that people get angry when they read an article that says XYZ company had $500 million in financial statement income but didn't pay a penny in tax. And so he would create a new alternative minimum tax, only this tax, and we're used to AMTs, this tax would have nothing to do with taxable income. It would say if you have financial statement income of more than 100 million bucks, you are guaranteed to pay federal income tax of at least 15% of your financial statement income. And again, it's been panned because, as I mentioned before, I got 9 volumes of code and regs over here. If you want to tax corporations, do it through those. Don't do it on something like financial statement income that's predicated on a set of laws that had nothing to do with tax policy considerations. So for those of you who are interested, a couple slides here on international credits and provisions that, again, I don't intend to go through with a mass audience, but I wanted you to have them in your slides just to see what's in there. And then we'll finish up with just some math. I love geeking out on this stuff, right? But what we have here is the Tax Policy Center telling you by income levels what the effect would be of a Biden plan. And what you see here, just at first blush, is the result of a targeted tax increase, right? You see, federal tax changes that are negative at the lower levels of income, and then positive at the higher levels, and very positive when you get into the very high levels. But let's take a quick look more granular before we head to Q&A, right? This is done by income quintiles, and the 80% quintile right here is about 160K. So everybody making less than 160K is getting a cut. Everybody above that is getting an increase. Now, 160K and above, that's a pretty wide berth, right? You got someone making 175 and you got Mark Zuckerberg. So we need some more detail. So 80 to 90 goes from 160 to 230. And you'll notice there's an increase there. And that should strike you as odd because Biden said there'd be no increases on people making less than 400. We'll come back to that. Then 90 to 95, we can skip that for now. Let's say above 1%, so above about 780, average increase of 260,000. The top 0.1% above, say, 3.3 million, average increase of almost $1.6 million, right? So, but what about this? The 95th percentile is 331. So under that, you're still seeing an increase. If Biden's plan is not supposed to raise taxes on people making less than 400, why do these two show an increase? And they show an increase because it has nothing to do with individual tax provisions. What it has to do with is just kind of a tax nuance that says when the corporate rate increases, right? When the corporate rate increases, it's not just borne by the owners of the corporation. The employees will bear some of the brunt of that corporate tax increase. So since Biden is proposing increasing the corporate rate from 21 to 28%, then shareholders will bear about 75% of that, and employees will bear about 25% of that. So we have here really what is more reflective of a corporate increase. So it's not actually an income tax, individual increase. And then last two slides, if you're ever interested, you could just look at by change, how much revenue it generates. And you can look at all the different items we talked about and kind of see how it would impact revenue over a 10-year period. Now you'll see something a little funky for a number of these. We're starting in 2026. It doesn't generate any revenue. How is that possible? Well, it's possible because what happens at the end of 2025? The Tax Cuts and Jobs Act sunsets. And so a lot of these changes Biden is proposing are just to go back to what the law was before the TCJA. So this presumes that those laws will expire, which means there would be no tax increase because that's what the law was going to be in the first place. All right. So there's a lot to unpack here. Again, you've got a lot of data at your fingertips, but I know you also have a lot of questions. So why don't we jump into Q&A, and I can, if it's if it's easier for you guys, whatever you want to do, you can read me the questions, I can read the questions, whatever is easiest for everybody, but I see them all here on the screen.
Tony, thank you very much for this extremely informative presentation. One of the key goals of our Business for Breakfast programs is to provide our audience information and key things that they can take back to their desks and implement immediately. And what you've done is given us a lot of things to think about in our business planning for 2021. And one of the questions is, what are the top 2 or 3 things privately owned businesses should be planning for in 2021 with the potential tax law changes?
Wow. I mean, that's such a great question. And we could go a number of different directions with that. I'm going to assume that the businesses have primarily domestic operations, right? Just for simplicity's sake. And so, what it really will come down to, I think, is we'll have to take, every business is going to have to take a look. We're going to assume for this question that all the changes we just talked about are enacted, right? That they're all going to come to fruition, say 1/1/2022. What should we be doing this year to plan, to be proactive, that sort of thing. Well, the first thing we're going to have to do is every business is going to have to take a look at simply their choice of structure, their entity selection, right? Whether being a C corporation still makes sense if the rate goes back up to 28%. Or if 199 Cap A disappears in some situations, if it makes sense actually to flip to a C corporation, right? Because we're going to have, and this is what I meant earlier about the 9 volumes of code and regs and provisions interacting with one another. The 199A deduction was designed simply to accommodate the drop in the corporate rate to 21%. And so if that corporate rate changes and 199A doesn't move in lockstep, there may be windows, there may be avenues to find a structure that results in significant tax savings, either on the corporate side or the pass-through side, depending on what the final results will be. So every business is going to have to take a hard look at, am I simply operating as the right entity choice? And then the biggest thing we're going to see, clearly based on the conversations that we had today, is for non-C corporation businesses where there is a preferential rate, if you have valuable assets or you've been contemplating an asset sale, or even if you are a C corporation, because that rate's going to go up, do you want to pull the trigger on any significant sale prior to the top capital gains rate potentially doubling? Or if you are the owner of a privately held business and you've been contemplating an exit strategy, right? This is where all eyes have to turn. The difference in tax if you sell pre or post a doubling of the capital gains rate is going to be monumental, absolutely monumental. I actually had some clients selling buildings and closing on 12/31/2020 using the installment method because they were worried that changes could be retroactive to 1/1/2021. So those are the two things that jump to mind.
Excellent point. And for those in the audience, there is an article, great article just recently written by Steve Griffith of Vectra Bank, published in the Colorado Business Magazine on selling your business. You got to take a look at that and take Tony's points and think about how you're going to be managing any sale of any business or asset this year, because both of those together will really help you. It's a great article. There's another article, another question on, can you provide an update on potential employee retention credit for those of us that have taken PPP? PPP is utmost on people's mind. Vectra Bank is going to start working on those PPP loans this coming week. And so that is uppermost on a lot of folks' mind who have taken it or who may get another one. So if you could comment on that, please.
Yeah, you guys got a couple hours? I'm joking.
You have about a minute.
Yeah,
we got to get to some others.
I'm joking, but listen, I'm doing tons of teaching on ERC right now. I wrote 2 articles for Forbes last week about the new ERC. The way to approach the ERC, I'll do it as quick as I can, is to look at it in 2 tranches. The ERC was here for all of 2020, but no one cared. Why didn't people care? Because you couldn't take the credit if you borrowed a PPP loan. Retroactive to 2020, that has changed. So everyone that took a PPP loan, me personally, I would say you halt on your PPP forgiveness application for a moment until you go back, kick the tires, and again, RubinBrown, be prepared to help people do that. But go back, kick the tires and say, what employee retention credit am I eligible for? Because yes, you're eligible for the credit, but you can't get both the credit and PPP forgiveness on the same dollars of wages. So analysis has to take place. You have to, optimize between the two. So PPP borrowers, every one of them has to go back to 2020, kick the tires and say, what kind of ERC could I be leaving on the table here? And then in 2021, we have now a new expanded ERC for the first half of the year where they made a bunch of computational changes that makes it very lucrative. This is the biggest action item for all businesses coming out of last week's legislation. Reviewing 2020 before you finalize your PPP application and saying, do I have am I allocating my payroll costs the right way? Because I can't double dip to get both the ERC and the PPP. It's huge. I'm teaching about it to my entire firm in about 2 hours. But again, anyone that's interested, in the name of shameless self-promotion, I published 2 articles for Forbes last week after the law came out that walks through the ERC for 2020 and then 2021.
Next one, Tony, is with the proposed increase in payroll taxes, how will employees and employers need to plan for potential changes in labor costs? And then on top of that, I'm going to have a couple of sub questions on deductibility of expenses. So.
Sure. I mean, look, that's going to be a tricky question. Compensation planning is going to become very, very, nuanced if this all of a sudden wages over $400,000 are going to be subject to a 6.2% payroll tax. It's going to implicate, options and the nature of options. I think incentive stock options are certainly going to come back into vogue because non-qualified options are wages subject to payroll costs. If you do incentive stock options right, you can avoid ever having that wage element. But listen, that is really the most significant, other than the capital gains rate, most significant increase we talked about here for for the Biden proposal is the additional 6.2% Social Security tax. And so, trying to put more into tax-free fringe benefits to compensate employees, but basically trying to manage that new potential $400,000 Social Security threshold where a new 6.2% tax is going to kick in is going to be critical. And it's going to mean business owners are going to have to take a look at their own compensation and figure out if there's other ways they can extract cash from the business, whether it's through rent or loans or whatever it may be, because that payroll tax hit is going to be significant.
How about deductibility of business expenses like entertainment? I've seen a couple of articles in the Wall Street Journal about changes to that. And can you talk about that, number one? And number two, the deductibility of medical expenses.
Yep, I'll give you those, and then I'll throw one extra thing on top because we can't let everyone go without talking about really the headliner of this last bill. But meals and entertainment, whether it's useful policy or not, it should help it's not retroactive for 2021 and 2022. You buy a business meal, right? And we have definitions of what constitutes a business meal. Can't be lavish, extravagant, got to be some business purpose. You buy a business meal from a restaurant, it is 100% deductible for the next 2 years, right? The obvious incentive there motivation was to revitalize the restaurant industry. Of course, the IRS is going to now have to figure out what's a restaurant, right? If I take Mark to a Rockies game and we go to the concession stand, is that a restaurant? But if we order same food from a vendor, is that not a restaurant? I don't know, right? So they're going to have to define that for us. So that's 100% deduction for meals and entertainment purchased from a restaurant for the next 2 years. Medical expenses, we normally under Section 213 can only deduct medical expenses to the extent they exceed 7.5% of adjusted gross income. In 2021, that was supposed to jump up to 10%, making it harder to get your medical expenses. The bill made permanent that 7.5% floor. So that's going to be nice. And then the thing I was going to throw on extra, because I can't believe I got this far in without mentioning it, but we weren't really talking much about the previous bill, is the expenses you pay with your PPP funds, right? Congress has now said, hey, you get the best of both worlds. Tax exempt income when we forgive the loan, but you still get to deduct the expenses paid with the PPP funds. That's the single biggest tax implication that came out of the Consolidated Appropriations Act of 2021.
Okay, we're going to try to squeeze in 2 more here because we're getting up to the 10 o'clock hour or the hour. What is the administration's posture towards low-income housing tax credit industry?
So I haven't seen anything specific from Biden on this. I guarantee I am just missing it because Kamala Harris's platform, right, was very, very focused on low-income housing, right? She had kind of her renter's credit, which I do believe is being merged into the Biden proposal. So I can't speak to it in detail, but I guarantee that's a me issue and probably not an administrative issue because, again, with Kamala Harris being the VP, a focus on low-income housing and low-income housing tax credits, I think are going to be a big part of that platform.
Okay, last one. Any changes proposed for 1031 exchanges?
So Biden has spoken about eliminating 1031s, across the board.
Wow.
Like the Tax Cuts and Jobs Act had eliminated it for personal property, but preserved it for real property. To me, I think that's something that could easily be left on the cutting room floor. I think it's something that sounds good from the pulpit, because one of the narratives that came out of the Tax Cuts and Jobs Act is, boy, they sure left a lot of nice incentives in there for real estate investors. And they knew that gets some people angry. I view 1031s as one of those sacred cows in the tax law. And you know what? It's a sacred cow that kind of makes sense, because you're not actually cashing out your investment. You're just changing the form of your investment, but you swap building for building. It's hard to tax people on the appreciation when they don't actually have any cash to show for the transaction.
Yeah. Well, we're at the top of the hour. Tony, thank you so much for your time this morning. This has been extremely informative and very, very helpful. It achieved the goal that one of the goals that we like to have for these Business for Breakfast, to give folks some things to think about, to take back to their offices and planning. And particularly since we're having it on January 8th, this is going to help a lot of folks in their business planning for 2021. So thank you very much. Thank you very much for the audience for tuning in. We appreciate it. We hope you have enjoyed this time. RubinBrown, Vectra Bank, and Sherman and Howard love providing these Business for Breakfasts. We will have more going forward. We hope that we can have one live soon, but certainly we're going to be continuing to take all necessary health precautions going forward until that time. But we thank you very, very much for being here today. And if you have any further questions, you can reach out to us.
Yeah, I would just add, I will be covering all the Biden, all tax reform, everything I write, everything I cover for Forbes or wherever else I put on my Twitter account. That's at Nitti AJ. But yeah, anything that changes, anything that evolves, I'll be writing about it, talking about it. You can bounce questions off me, whatever you need.
Kurt, any last words?
Great. Thanks, Tony. Thanks, Mark. Thanks,
Thank you very much, folks.
orchestrating this.
Have a wonderful weekend. We look forward to seeing you soon. Bye-bye.
Take care, everybody.
Take care.